Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's video insight. Well, the most common question that I'm being asked amid this technology bubble bursting is where to next? Of course, we don't know where the market's going. We don't know if it's going to go up or down next week or next month. But what we do know is the portfolio businesses that we own are going to increase their value substantially over the next 5, 10 or 20 years. But where to right now? Is the market going to go down further or will it bounce? And what about the next couple of years? Well, in order to answer that question, I need to give you some statistics, and the best source of those statistics is the Montgomery Fund itself. In August 2012, when the Montgomery Fund began, we had a margin of safety in the portfolio of about 40%. It meant that the portfolio was good value. The stocks represented good value. And as well as the value rising, there was clearly an opportunity to make some short-term gains. Since August 2012, that value has eroded to nothing. In other words, the portfolio today is not expensive, but fair value. It's not cheap, it's not expensive. So where to next? Well, currently the Montgomery Fund has about 28% cash. That tells you two things. Most importantly, it doesn't tell you that the stock market is going to fall precipitously or imminently. What it tells us is that there's not a lot of value elsewhere in the market, and the statistics are bearing that out as well. In fact, the non-investment grade companies that we know of in the stock market are trading at a premium of almost 50% to their own intrinsic values. That means the rest of the market is very, very expensive. So while our portfolio of invested companies is fair value, the reason why we've got the cash is we've sold things that were expensive and we can't find anything else to buy that's cheap. So at the moment, here's the dilemma. Good quality businesses are fair value, but their intrinsic values should be rising on an average of what we think will be about 12.5% over the next 12 to 18 months. And that's 12.5% per annum. The rest of the market is frighteningly expensive. Now, it could be that because the rest of the market is expensive, that the stock market declines. If it does, we've got almost 30% cash to be invested. But it could be that the high quality issues rally even further. If poor quality companies are trading at a 50% premium to their value, then surely it makes sense that good quality companies should be trading at an even greater premium rather than fair value. So if on the one hand the stock market continues to rally, we believe the good quality companies that we own are going to rally more. On the other hand, if the stock market declines, well, we've got plenty of cash to take advantage of opportunities as they present themselves. Now, if you were hoping that we would give you a grounded forecast on where the market was going to go, I'm sorry to disappoint you, but the reality is we just don't know. I hope those insights help you in your thinking, and we look forward to seeing you next week on the next video insight. Please continue to follow us on Facebook and Twitter.